Welcome to the Mayo Clinic Ophthalmology Podcast, brought to you by Mayo Clinic. I'm your host, Dr. Andrea Tooley.
And I'm Dr. Eric Bothan. We're here to bring you the latest and greatest in ophthalmology, medicine, and more. Welcome to our second financial podcast here in our Mayo Clinic Ophthalmology podcast series. If you haven't listened to our first episode with Roseanne Bozer, please consider checking that out. That was episode 20. At that time, we discussed choosing a financial advisor, some good versus bad debt decisions, and many more details that she shared with us. And today, we're back for a more in-depth dive with a certified financial planner named Tom Knutson.
Today we are joined by Tom Knutson, a certified financial planner professional. Prior to joining Mayo Clinic, Mr. Knutson worked in the wealth management and investment advisory industry. Listen in today as we do a deep dive into financial planning for physicians at every stage of your career. Welcome, Tom. We're so happy to have you here. Tell us about yourself, kind of your career trajectory, how'd you get to Mayo, and then what do you do here at Mayo as a certified financial planner?
Yeah, thank you very much for having me here today. I'm really excited to be a part of your podcast. So kind of starting with my career trajectory, I am a Minnesota native. I ended up going to college at the University of St. Thomas in St. Paul and studied financial planning there. And while I was in school at St. Thomas, I really was passionate about the industry, and I knew it was something that I had an interest and drive to pursue further in my career after college. But I was really struggling to find that right fit of what financial planning firm would be right for me, that I could provide the best advice possible to my clients without having any sort of conflicts of interest. So I took a couple of years right after graduating college to do a different career path while I was exploring different financial planning firms to learn more about the industry and make sure I got into the right fit immediately into the career. So from there, I ended up interviewing with a variety of different firms and found fee-only financial planners and started working with the firm in Edina and started my career there for the first 6 years of working in a firm which, if you're not familiar with fee-only financial planning, those are firms that aren't charging any sort of fees to their clients for commissions or trading fees, anything like that. It's just the straightforward investment management fee or financial planning fee that they're charging. There aren't any hidden fees behind the scenes. So that was something that really aligned with my core values and ethics, that I wanted to make sure there was transparency in the fees we were charging clients and that my interests would be aligning with the firm as well. So as I was pursuing that career, I really enjoyed working with the firm I was with in Edina and ended up meeting a wonderful woman and getting married to her who was a native of Rochester. So we ended up moving back down here after she wrapped up dental school and being a little bit closer to family. So that's what brought me to Rochester. And then when I saw an opening with Mayo to do financial planning here with physicians and consulting voting staff, that's when I made the transition to come on staff here. So it's been a great experience and really excited to be here.
You know, I appreciate your sharing a little bit about your decisions over what type of financial planner and how the firm and the structure of how the product can influence your own desire over what type of role and service you want to be for clients. I think most of us recognize that we know our field well, but when we get outside of our field, including financial planning, an advisor is so critical. Mm-hmm. But I think people universally don't understand, or broadly don't understand the fees, the nuances, and they worry that their choice in a financial planner wouldn't be ideal because they wouldn't even understand where all the fees are going and whether the advising is truly in their best interest. Mm. So share for people looking, or maybe whether they're new residents graduating and becoming in a position where they need to learn about wealth management in some way. How do people make that choice? Like, how do you go look for a financial planner? I mean, you can get word of advice from somebody, mm-hmm. but what's your recommendation when you look at the marketplace out there? What red flags are there, or what pearls would be there that you would share to people on picking a financial advisor?
Yeah, that's a great question, and it's a super important place to start, because when you're developing that relationship, you want to make sure that you're working with a firm that has their interests aligned with yours. So from a first place to start, if you are a part of the consulting and voting staff at Mayo, I would highly recommend utilizing the Office of Staff Services here. It's a phenomenal benefit that Mayo has, which is very unique to the institution. All of the planners on staff are salaried employees. There are not any commissions or any sort of misalignment of incentives that go on between the people we're able to help in our office. And if you were looking for additional firms to work with beyond what our office is providing, or if you wanted second opinions, where I would go from there is get some opinions of people within our office of what firms we may recommend working with, and then going out interviewing a wide variety of firms, asking the hard questions of these firms while you're initially meeting with them, so that you're able to have a good understanding of where their interests are, how they're charging those fees before making that decision. I think a common mistake that people make is they know someone in the industry, whether it's a friend from college or a family member that works in the industry, and they just assume, well, I know this person really well, they're going to take care of me. And that person may really want to take care of the individual, but they just might not be at the right firm that allows them to do that in the best way possible. So going out and making sure that the specific firm aligns with your values and is charging in the correct way would be the way I'd recommend. And then if you really want to go from a deep dive perspective to make absolutely sure and be certain that the fees are going to be the way that you want them to be charged, you can actually go out on the SEC's website. There's what's called a broker check link, and there are different disclosures that advisory firms have to disclose within the SEC, and you can type in either the individual advisor's name or the firm name, and there are reports that they have to file each year that show the amount of fees that they collect as a firm, how they charge fees as a firm, and you can read through those documents to see, and it's very specifically outlined. So
What does SEC stand for?
the Securities and Exchange Commission.
Okay.
So on those disclosures that they file each year, it would say something like they file assets under management, which may be the typical 1% fee that you would see, and that fee is going to be charged based on the assets that they're managing for you. There may be a box checked in there that says they're charging commissions or they're charging an hourly fee. And then by each category, it breaks down how much they're charging and where those fees are coming from. It also breaks down what type of clients they're working with too, which I think is really important. You want to make sure that the advisor or firm that you're working with, that their expertise is in the area that you need. So you may see an advisor out there that lists they're working with thousands of clients, and it'll show the majority of their clients have less than $500,000 of assets with them. Well, that tells you what type of advisor that person is specified in or has a specific area of expertise in. Or there's other firms you might look at and they have only a couple hundred clients and they specialize in a little bit higher net worth. So I highly recommend going out and looking through those reports. I think it's worth the extra time to make sure that their interests are aligning with yours.
I had no idea that information was available. And it's the same for physicians. You can see our consulting fees and who we're working with and where we're getting money from, so that all makes sense. Mm-hmm. Do you think it's important to have a financial advisor who mostly works with physicians, or is it more the bracket, the wealth kind of tier? Is that more important?
I think it really depends on where you're working. So if, as a Mayo physician, you have the ability of working with our office, like I mentioned, but then beyond that, if you're going out and getting extra advice from an outside advisor, I think it would make the most sense to have someone who specializes in your income or wealth level, mm-hmm. because then they're going to be able to help advise on different tax strategies for your income or wealth, or different outside investment opportunities that may be available to you. If you're a private practice physician, it may be more helpful to work with someone who's specialized in focusing in private practice physicians, where they're able to help with different business deductions or managing employees, things like that, tax incentives that you may be able to take advantage of while running your your own business. So I think it's really a case-by-case basis.
In the case-by-case side of things, if one spouse is a physician, another spouse has another occupation, whether it's a business, a private entity, or a farm is involved. Are there other nuances where you find yourselves asking for another type of advisor be brought in, or is that typically not needed?
We're always asking about farms over here.
Yeah. Yeah, it's very common here in southern Minnesota. So yeah, I would say that if you have a specific area that you need help in, it would make sense to get an advisor that has an area of expertise that matches what your need is. So there are advisors who only work with people who own farms or have family interests in farms. And I would highly recommend that if you have a large farm interest and it's something that you need that consultation with. If your spouse is a business owner, there are a wide variety of different business tax deductions and different strategies that need to take place within private businesses. So that would be an area that I'd want to make sure that you're working with an advisor that specializes in that. If you have large generational wealth that's passing on from family to family, that would be another area that I would highly recommend focusing on a different type of advisor that's working with you to make sure that trusts are set up appropriately, that estate tax is working in your best interest as well, to make sure you can continue that going forward.
I've always thought more of a financial advisor to be one person that would shepherd that part of your life as long as you stayed living in that area and were happy with them. But your reflection there is bringing in other advisors. So do people might have a financial advisor, say here at Mayo, or we have listeners from across the country listening to us that have a key financial person, but at different stages then you would bring in other potential advisors for certain aspects of their life or their transitions.
Yep.
Okay.
Yeah, I would recommend that. I think if you could get an advisor who's going to act as that key quarterback and relationship manager for you throughout your life and have that relationship with them, then they can bring in those people of expertise while you're experiencing different transitions in your life, because there are very specific items that you may have the opportunity to take advantage of throughout your life where you do want to make sure you have someone who's specialized in it. I think similar to medicine, there are kind of the general practitioners, and then there are people who have their very specific expertise in their area of medicine, and it makes sense to pull those individuals in at different times when there's different needs. And I think the financial advisory industry is moving more and more in that direction as we move forward as well.
I like that strategy a lot. One question I hear a lot from people in kind of my demographic, which is early career, kind of within the first 5 years of practice, you're coming out of medical training, and I know we talked to Roseanne about this a little bit too, is questions of spending versus saving. We've been living as medical students and residents for a long time, ready to make some big purchases, house, car, moving for a new job, and probably having a young family at the same time, there's kids' expenses, and then really wanting to kind of step into the lifestyle of a physician when you've been living kind of lower than that for many years. How do you advise, or what would your advice be to people in that position versus, like, how much do you need to be saving versus how much can you spend, and how do you make those decisions?
Yeah, that's a very good point, because it is common for individuals, especially in the medical field, that it takes you a long time to get into the place where you're actually earning the high income. So there's been this kind of withholding that you've had to do throughout your life of you've seen your peers go out and be able to explore life a little bit more than you've been able to because you've been busy studying and your income hasn't been quite as high. And then all of a sudden you're reaching a huge jumping point where your income is going from that resident salary to being fully on staff. So once you reach that level, it is very important to kind of come up with those guardrails and that strategic plan around how you want to be spending, how you want to be saving going forward, because it's easy, like you mentioned, to all of a sudden feel like you have all this disposable income to go out and be spending, and things can kind of snowball and get out of hand quickly. So as a first step, student loans are always a major portion of what those early career decisions are when you're just out of residency. So if you are working for an institution that qualifies for public student loan forgiveness and you're going for that right away, making sure that you're following the strategies that are appropriate for that public student loan forgiveness. So if you are going for the forgiveness, you're making the minimum payments for the 10 years while you're working for the qualifying institution. If you aren't working with an institution that's qualified, your strategy is going to be very different, where you're actually trying to pay down the debt as fast as possible, ideally, or paying off the highest interest rate first and then going from there. From a general standpoint around savings, it's generally recommended between 20 and 30% of your income that's coming in to go towards savings and debt payments. At Mayo, speaking specifically to our benefits here, if you are going for the public student loan forgiveness, you're making the minimum monthly payments. We'd want to make sure that you're having an emergency fund right away after you've finished up your residency. Ideally, you'd have that established throughout your residency as well. But for a single income household, we'd look between 6 to 12 months of expenses, so that if there is a major medical need, you have issues with a car or house, any unexpected needs that may come up, that you have those expenses set aside, or those funds set aside for that emergency, so that you're not put in an even worse situation if something were to arise. If you're in a dual income household, which I know is also very common, that's typically between the 3 to 6 month expense range, so a little bit shorter because you have that other income to rely on if there were to be something that would happen with that one individual. You want to make sure that you're set up completely from a benefit standpoint with whatever institution you're working with, making sure that you have your disability insurance, life insurance in place, not overinsured, but making sure that it's the appropriate amount, maxing out retirement accounts, making sure you're not leaving any sort of dollars on the table that your employer's giving you for free. So there are typically employer matches on 403B plans or 401k plans. So you want to make sure that you're just hitting the contribution limits that would allow you to receive the full matching from your employer, but before moving on to saving in other vehicles. But typically, just from a Mayo perspective, beyond the 20 to 30%, there's a lot of conversations that I have with physicians where they say, I've paid off my student loans and I know that I'm maxing out my 403B plan and 457 plan, which is another option we have here. And they want to know if it is okay to go out and spend those dollars. But with having the pension and maxing out the 403B plan and 457 plan, those are some guardrails that you know you have in place where if you are maxing out all of those plans, you can say, yeah, I do feel comfortable at this point to go out and spend a little bit more money.
This is great. I'm coming to you for all my advice. This is terrific.
As different stages, so as you get out, I wasn't even aware of, and maybe you could clarify with me, what in the marketplace, how often do firms and companies now have loan forgiveness plans? Because that's rather a newer thing to do. Is it common in society now, and whether you're working at Best Buy or Mayo, or is that a fairly minor slice of corporate America that would support loan forgiveness plans or deferral?
Yeah, in order to qualify for it has to be a nonprofit institution. So it's based on whatever institution that you're working for, which is a very important factor to consider when you are finishing up your residency and deciding where to work. Because I will see individuals who say, well, this nonprofit hospital is offering me X salary, but this private institution is offering me a slightly higher salary. I think I might end up going with the private institution just because the salary is slightly higher. But when you look at the total picture and you factor in the public student loan forgiveness, medical school can be around $400,000 or $500,000 of loans that people are graduating with. And factoring in what forgiveness might be in place compared to having to fully pay that off on your own at a private institution, it really makes a big difference.
Yeah, that's a huge deal.
Yeah. So then as time goes forward, mid-career, and you're looking at other options, you shared a testimony or a comment that shared with you with people feel flexible to start making choices, and maybe you decide to buy a sailboat or something. But if you are going to start diversifying beyond the core retirement vehicles that are there.
Yep.
What do you often find encouraging, or what recommendations are you giving people that look at diversifying options in trying to keep their investments balanced and strategically wise?
Yeah, so I think there are multiple components of the diversification factor that come into play. One is you want to be diversified within the accounts that you're holding, kind of regardless of what account it is. So making sure that you're not overly concentrated in an individual company or a specific fund, making sure that there is broad diversification within those holdings. And then beyond that, going in to say if you were already maxing out all of the retirement plans that are available to you within your employer plans, maybe you'd be going out and opening up a brokerage account beyond that, which would be an individual account, a non-retirement account, and investing there because you have excess dollars beyond the contributions that you've been making into your retirement plans. And one piece of caution that I always have for individuals when they are starting to move beyond the retirement accounts and investing in the individual accounts is making sure that you're investing dollars that the intention of the investment is for the long term. Ideally, I'd like to see an individual investing for a time horizon of 5 or 10 years and greater. If you know you have an upcoming expense, whether that's a wedding, a car purchase that may be on the horizon,
house renovations.
House
That's where I'm
renovations.
at.
Exactly, very good point there. And anything like that may come up within the next 1 to 3 years, ideally you would not want to see those dollars invested in the market. It's hard to predict what the market may do in the near future. Over the long term, we have a good idea of what the market's going to do for performance-wise through various research that's been done, and then also historical measures as well. But in the near term, the market can be very volatile, and we would not want an individual to be investing funds that they would need in the next 1 to 3 years, have the market take a big downturn, and then need to sell those positions at a loss in order to be able to pay for an expense. So you'd be hurting yourself in multiple ways by doing that.
Yeah, I've appreciated through my financial advisor the science and strategy behind being more conservative, so you have a certain amount invested in different ways, and as my children got closer to college, knowing you're going to spend, starting to dial back that portfolio I was struck by what a journey and art that is, and certainly understanding the timing and understanding the risk values of different. That was for me a learning curve. With our advisor. Now we're getting on the tail end of college, so I can shift gears in another direction. But it was a very strategic season.
Yeah, the saving for college process is very similar to retirement, where it gives you an idea of, I have this time horizon where I know that I need to save X amount of dollars, and there's going to be a date or a target date that I'm going to need these funds. So it is an interesting process to go through kind of prior to your retirement if you are helping your kids with your college expenses. Because, for example, the kind of main account that you would use for saving for education is a 529 plan, and as long as you use those funds for education expenses, they can come out tax-free, and you don't pay any taxes on the growth as well. So you can back into the calculation similar to retirement of, if my child goes to X school, this is the amount of money that I would need to save every year or every month in order to help them out, and here's the investment returns that I would need to get. And like you mentioned, as they're younger, and if you start the account when they are in their younger years, you can be a little bit more aggressive. And then as you're getting closer towards the need of those funds, you need to get more conservative to make sure that there isn't a big market pullback right before they start college. And similar to retirement, you could be more aggressive as you're in your early years of your career, and as you're looking towards those retirement dates and needing those funds beyond your income earning years, that's when you start to get more conservative there as well.
When I first started with when my kids were sub 5 or whatever they were, thinking about college 20 years later, 15 years later, the average college tuition and balance was in the $35,000 range. I remember my advisor said, you probably need to save more than 50 for what it's going to be like in 15 years or 20 years. And sure enough, now it's meaningfully higher than that for many private institutions. And there's a range, as you know, depending on what your interests and target are, and there are ways to be strategic. Even that decision itself is sort of a hard journey because you don't know whether or not public education would be the choice or private, and what the range would be. I imagine with your clients, it's a journey to figure out what their priorities are, what their interests in supporting, what percent of their college expenses for their children, and the numbers always seem a little bit bigger than you expect.
Yeah. Absolutely. And it's becoming more and more of a difficult calculation to make. On average, college education expenses have been rising 5.5% per year. So if we were to take today's numbers and extrapolate that going forward, it almost looks like college is going to be unattainable for a lot of kids in the future. So it will be interesting to see how the education system changes in the future. Because if we look at today's prices of an in-state college tuition of around $30,000, that may be closer to the $90,000 or $100,000 range by the time children who are being born today might be reaching college. So we'll see how things change.
It's interesting how, as much as the prices ranged because my children are not, I have one still entering the college season, but the others are in or through. It's striking how when you actually get there, the support from the colleges in a variety of ways, especially when your academic level is successful in high school. It's surprising how much there is a little bit of a relief from the numbers that are the original sticker shock. And I was surprised that even no matter what the sticker looked like on the front end, at the end, and say you have 8 different private colleges that you apply to, the stickers might look very different originally, but in the end, they all come out within a very similar range that was probably, and again, it speaks to what scholarship scenarios you have there. But it was strikingly pleasing that it was a little bit more relief than the original sticker shock was supposed to be or expected to be.
Wow.
Yeah, and that was my experience as well. Looking at different in-state, out-of-state public and private institutions, the upfront sticker price of those institutions were very different. And by the time I did receive different scholarships and merit-based awards, that they all were almost even. Yeah, so it was easy to select amongst which school.
It wasn't a driver as much as we thought it would be. And this is for speaking to my few children that have been through college at this point.
Yeah. And with the Secure Act 2.0 that was passed last year, there have been new laws that have come into place which help with offsetting some of the 529 plan contribution limits and also some of the rules around it. So like you said, if you do end up over contributing into 529 plans for education, your children receive large scholarships or different awards, and you need to redirect those funds, you can always change the beneficiary of the account, or with some of the new rules that have passed, there are different laws around allowing you to move the funds out of 529 plans into Roth IRAs and strategies around that.
Oh, that's great.
That's a very important.
Because what if your kid gets a full ride, or what if they end up not going to college?
So, and historically, my prior advisor recommended not putting as much at 529 because you save for college, and if they don't go to college or they go on a military scholarship or something, then they're stuck in a 529, and you could apply it to someone else going to college, but there's that scenario that it might not be utilized. So it just clarified us when it changed now and define that opportunity that's there. So if it isn't spent on college, it can go into a Roth. And what are the limits? What are the opportunities there for that transition?
Yeah, so there are a lot of different rules that kind of determine when you can make the change from the 529 plan into a Roth IRA. But a few of the high-level ones are, it follows the same contribution limits that are the contribution limits for the Roth IRA of that year. So for 2024, a Roth IRA contribution limit is $7,000. If you met all of the rules for being able to make the transfer from the 529 plan into a Roth IRA, you could move $7,000 from the 529 plan into your Roth IRA. A few of the other
each year subsequently, you could keep doing that.
Correct.
Yep.
There are limits on the maximum number of contributions you can do over into the new plan. A few of the key rules are that the account owner of the Roth IRA needs to match the beneficiary of the 529 plan. You can change the beneficiary of 529 plans very easily. So if you wanted to change that to be yourself and fund your own Roth IRA, or if you wanted to leave it as your kids as the beneficiary and move it into their Roth IRA, those need to match. The funds also have to be within a Roth IRA for or within a 529 plan for over 15 years before you can make any of those transitions out of the 529 plan.
That makes sense.
There are a few rules you just want to make sure you're watching out for before you start moving money between the accounts.
Wow. Fascinating. I got to start thinking about all this. I've still got some time, right? I hope. I also wanted to ask you too, talking about diversifying investments, I feel like hot topic things that people talk about are investing in real estate and then cryptocurrency. It's all the rage. Bitcoin's really high right now or whatever. So what do you think about those other options? Are those good ideas for physicians or absolutely not? Like, how do you advise some more of those in kind of niche areas of investment?
Yeah, I'll start with real estate and then we can go to Bitcoin after that. But as far as real estate, there are a variety of different options to choose from in investing in real estate. You can be more active in your real estate investing where you're actually going out and purchasing a property, finding renters to rent from you. I'd want to make sure that if you are doing that, that you're setting aside appropriate amounts of cash in case you can't find a renter, or if there are issues with it, ensuring that you have the appropriate legal structures in place, things along those lines. You can also invest in real estate a little bit more passively through different index funds that will invest in real estate, or REITs that are out there, which is a real estate investment trust. There are also different managers of funds that you would give your money to, and they'll go out and find different properties, whether that's residential or commercial, and invest in those funds for you on your behalf. The big thing to consider when you are doing REITs or different funds, making sure that you're keeping an eye on how much the fees are within these different investment vehicles. Typically on these real estate funds, they can get pretty expensive. So you want to make sure that the returns and the fees are justified for what you're paying for these funds. Otherwise, you may look at just the returns of a regular equity investment and find that that's not necessarily worth getting into from a real estate side. And if you are doing the more active side of the real estate where you're going out and finding different properties that you want to personally own, making sure that you have the legal structures in place with that. So I'd recommend working with an attorney and tax advisor on that as well, because there are a variety of different strategies that you can employ to help protect yourself and take advantage of different tax opportunities along the way. And then as far as Bitcoin, it is very popular right now because we're reaching near all-time highs again. The level that it's at right now, I believe it's above $66,000 today, and the last time it was near this level was in 2021. Unfortunately, right after it hit this level in 2021, we saw about an 80% dive in Bitcoin's price. So people who were just hearing about it at that time, learning about it as an investment vehicle, trying to do their research, a lot of them got trapped in at those levels and had a huge loss. And if they're still holding it today, they may be able to get out near even. But a lot of people did end up selling at a loss. But from a high level, Bitcoin is cryptocurrency. It's a digital asset, which is new and something we're all still learning a lot about. But as a key takeaway, I just want to make sure everyone knows that it's a speculative investment. It's one of those investments where no one can guarantee whether it's going to be around in 100 years or whether it may be much higher in 100 years. There are arguments to be made on both sides of it. So making sure that if you are getting involved in investments like cryptocurrencies and Bitcoin specifically, that you're weighting your allocation towards it appropriately, realizing that it may not be something that works out in the long term. Yeah.
It's very interesting. I understand the appeal.
Yeah. I had one just from wealth management, but also regarding debt and Visa card debt and management. Something I think we all recognize isn't ideal. But when you take as a family a Visa card out, we took one out with our college age kids, thinking it was a good idea that we shared the account and could help to shepherd to make sure that it was successfully managed and paid. And we thought a joint account would be a good thing, but apparently there are. That your credit score for the college students, having a credit card is a good thing for their credit score, but having joint accounts in some ways is not. Are you familiar with that at all for families and college age graduates? The benefits or negatives of sharing credit card ability and cards and debt versus having them be separate?
Yeah, there are some considerations that you just want to make sure, like if the college student was able to go out and get their own credit card and establish their own credit early on, that would be ideal. The reason for kind of combining parents and children together may be a circumstance where the child isn't able to get approved for a credit card and they need it. But I wouldn't necessarily recommend that for building credit. It'd be more of if there was a need for having that card in place. As a parent, if you wanted to be making sure you're monitoring their expenses because you're helping them out, or making sure that they're spending money wisely. There may be some opportunities for you to get commingled on the card to keep an advisory view on the account. But from a pure credit standpoint, ideally it would be that the child is able to have their own credit and build it along the way, showing that they're making payments on time and that they're being responsible with the card. It's something that can be done earlier on than most people think of, before they're even out of college, like you mentioned, so that when they are graduating and they may be looking at saving up for that first home purchase or buying a car, they may be able to get a better rate because they have a good credit score in place. But I do always caution people that you want to make sure when you are establishing your credit that you're fully aware of what risks you're taking on, because you don't want to get into a position where you're in college and you might not be as serious about your finances at the time and you end up actually hurting your credit score because you were trying to use a credit card during that time frame to pay for things that you actually didn't have the funds for, and you may not have had the responsibility at the time where you're ending up having to make up for those expenses throughout the beginning of years of your career and reestablishing a good line of credit. So if you are going to try to start with that, establishing the line of credit earlier on, you just want to make sure that you're doing it in a responsible way.
Yeah, I think for us it was here. These expenses mom and dad will pay for, so here's a Visa we can share, so they can ring it. And obviously it can be abused in the other, but it was a convenience that we would be able to help support this aspects of their college expense. But they, at least in our family, we found that there was a negative impact on their credit score, not even neutral, by having them on ours, even though our credit was very high and they were starting out in the credit. I think it's viewed as a negative for them. It's almost like if you link it with them, it must be something wrong with their credit, or wrong with their responsibility. So it is better to have them separate.
Yeah.
So interesting. Wow, Tom, I learned so much. Thank you for joining us. This was incredible information, really practical, direct. I appreciate it so much. Thank you for sharing all of this. Thank you for joining us. Hope we can have you back again.
Yeah, thank you for having me.
It's a pleasure. Thank you.
Nice to meet you both.
You can find all episodes of the Mayo Clinic Ophthalmology Podcast on our website.
Thank you for listening, and we definitely look forward to sharing more